And look, apologise, we've had a slight technical glitch, so we went on a little bit early. But look, welcome to this week's Hamilton Wealth Partners Thought Leader Series webinar. This week we're joined by Paul Bassat. He's the co-founder and partner of Square Peg. Just as normal, I'm just going to kick off with a general advice warning. So the information contained in this webinar has been provided as general advice only. The contents have been prepared without taking into account your objectives, financial situation or needs. You should, before making any decision regarding any information, strategies or products mentioned in this webinar, consult your advisor to consult whether that is appropriate, having regards to your objectives, financial situations and needs. Also, just a housekeeping matter, we are going to take questions after Paul has had a chat to us, and to use the Q&A button at the bottom in the toolbar at the bottom of the screen. I'm going to start with just sort of dangerous words that these are different times, and people beware when people say that, as they say. But the crisis of the past 2 months has and will further transform how we work. We're using Zoom, for instance, to deliver this webinar today, and to host it. The advancement and use of technology has changed not just quickly and rapidly, but how we work going forward. An agile workforce is another aspect of this as well. So I've asked Paul to talk to you in the context of this change, where we believe it's going to stick, and the opportunities he sees and believes as a result of this new environment that we're in. So welcome and thank you very much, Paul.
Thanks, Will. Good to catch up, and we're also getting used to this format and stuff like that. It's actually, I think, a really good format, obviously, to sort of communicate effectively and chat to a bunch of people. It's not perhaps as intimate as face to face. I was going to keep Will's sort of comments, pretty high level across sort of 2 or 3 sort of core themes or questions, and then hopefully we can have a lot more of a conversation with people having Q&A. First thing, I think it's actually worth spending a moment on talking about actually what venture capital is, because it is an unusual asset class. It's probably different in a lot of ways to most other asset classes. The first thing you do, whether you're buying a share on the share market, or whether you're buying property, probably the first question you ask yourself is, what could go wrong? What's my downside? How do I mitigate my risk? And venture capital is much more about looking for what can go right rather than what can go wrong. In simple terms, if we invest $100 in a business, we can only lose $100. But if it's successful, if we get it right, if we get it really, really right, it could be worth 10 times that amount, 50 times that amount, 100 times that amount or more. One of our early investments is held at 228 times its cost, based on its most recent valuation. And so our business is about looking for outliers. That's what venture capital is about. And you have to be prepared to have a high tolerance for risk. But really what we're saying, if you think about any venture capital fund that delivers a good return to its investors, and say a top quartile fund, which is typically sort of 20% IRR or thereabouts net IRR, typically through various vintages. Essentially 95% of those well-performing funds have one investment or more that returns the entire fund on its own. And so therefore it's axiomatic to what we do, is we're not going to invest in a company unless we think there is the possibility, obviously not the certainty or probably even the likelihood, but unless we think there is the possibility of that individual company returning the entire fund on its own. And so that's what our business is. It's unashamedly about looking for outliers, companies that we think have the potential to become very, very large and very, very important companies. And so I think it's worth just talking a little bit about what is it that we're looking for. It starts with a problem. What is the problem being solved? Is it a real problem? Is it on the other hand, is it a solution looking for a problem rather than a real problem? So identifying what the specific problem, or put another way, what the opportunity is that's being pursued. So what is the problem? Secondly, and most importantly by far, is who is solving the problem. And so when we look at founding teams, there's a whole bunch of different attributes that we look at in relation to those teams. And judgments we make around their resilience, their passion, are they doing their life's work, Do they have the self-confidence and ability to surround themselves with people who are more talented than them? So there's a number of attributes we look at. But what's the problem being solved? Who is the problem? Who is solving the problem? Thirdly, when is the problem being solved? Timing is incredibly important. I came across a few days ago a screenshot of the homepage from Seek. It was literally our first homepage from 1998, and apart from the fact it was awful design and not particularly great on the eye to look at. There was an article on the homepage about what was then called telecommuting, i.e. work from home. And really, so we've been talking about that concept for at least 22 years now. I also came across, also from 1998, a cover of Time magazine saying, say goodbye to your mall, and basically talking about the end of the shopping mall as a result of e-commerce. So these things have been talking about for sort of 20 plus years, and clearly now actually working from home and online shopping are very much becoming mainstream, but we're getting the timing right is critically important. And then lastly, how is the problem being solved? Is there something defensible? Is there something unique about the solution? Is there something about the technology that is hard for others to replicate? Did the business have network effects that create a sort of a natural barrier to entry, like a marketplace business such as a realestate.com.au? Understanding exactly how that problem's being solved and what's unique and defensible. That's a sort of that's I guess is a simple framework for how we think about businesses, how we assess businesses. And to put that into context, we look at probably about 1,500 companies a year. We might spend a chunk of time with 100 of them. We perhaps deep dive into 20 or 30 of them, and maybe invest in 8 or 9 or 10 companies a year. So really identifying those companies that we think have the potential to be real outliers. Will at the beginning said this time it's different, I think perhaps slightly ironically, but this time really is different, at least for those of us who weren't around for the last pandemic in 1918-19, which I'll assume is most of us on the call. This is obviously a very, very unique situation for all of us. It's been a very difficult time for a lot of people with their businesses, with their investments, with their jobs, worry about elderly family members, etc. So it's obviously a really difficult time. And I guess the other thing, other big learning for me is not that we need reminding, but sometimes it's good for us to be reminded what an amazing place Australia is to live, and how lucky we are to live in Australia. And a lot of these sort of things that impact the rest of the world, we seem to some extent be shielded from. At least it's been to date nowhere near as traumatic experience for us as it has been for some parts of the world. I want to talk though about this pandemic and what it means for venture capital. And, I will say it with the disclaimer, we're 10 weeks into this crisis and lessons are emerging, and we'll know a lot more in another 10 weeks time. And we'll know a lot more in 3 months and 6 months and 12 months time. But I think certainly we are starting to get some clarity around the core themes. And if you think about venture capital, modern venture capital as an asset class, essentially modern venture capital has been around for about 50 plus years. The late 1960s, the West Coast of the US is where you sort of saw your early venture capital funds emerge in the Bay Area. And for most of that period, venture capital funds have returned as an asset class, have provided pretty decent returns for investors, and returns that are commensurate with the illiquidity and the risk. But there's been obviously some periods where those returns have been very, very strong. And in particular, the period from 1994 to 1995 through to about 1999 is the absolute standout period for venture capital investing. The returns were absolutely exceptional. It was a real golden era for VC investing, for technology investing. And obviously that coincided with the rise of the internet. It's been the main catalyst for why it was such a great era for investing. If you look at the 10 largest companies in the world today, and I'm cheating a little bit on including Apple in that list, who people know was founded in the 1970s, but essentially was refounded with the return of Steve Jobs in, I think, 1995 from memory. But if you look at the 10 largest companies on the planet today, 5, including Apple, were founded in that 5-year period. I mean, it is a quite remarkable statistic. And it wasn't just those 5 companies. The number of amazing companies that were founded in that 94, 95 to 99 period, the dot-com era, is quite extraordinary. Literally trillions and trillions of dollars of shareholder value were created in that period. We think the next 3 to 4 years is probably going to be the best era for technology investing since the dot-com era of 94 to 99. And so why? Why are we excited in terms of what this means for innovation and what this means for sort of startups emerging? In simple terms, what we've seen in the last 6, 8, 10 weeks is a sort of an equivalent of a decade's worth of activity in terms of the transition from traditional business to online, in terms of the way both consumers and businesses operate. And we're obviously on a Zoom call today. Zoom had 8 million daily users in December. It had 200 million daily users in March and 300 million daily users in April. I mean, it's worth dwelling on that. 200 gone from 8 million to 200 million to 300 million in the space of 4 months. And really, the reason we exist, the reason why we started Square Peg back in 2012 was because we think the great story of our era, the most important thing happening in the world from that period of the mid-1990s, probably continuing for the next 10, 20, 30 years, is essentially the move of so much activity to online. And then associated areas, obviously the mobile internet, artificial intelligence, etc. But it's really just this incredible move of activity to the internet. And what we've seen, as I said, is a decade's worth of activity in 6 or 8 weeks. And that sort of sounds hyperbolic, but actually there's literal examples. Online shopping in the US in 2009, 11 years ago, in 2009, online shopping represented 5% of sales. By the end of 2019, it had got to 16% of sales, so growth of 1,100 basis points in a decade. In April, it was 27% of sales in the US, retail sales in the US were online. We've just seen this dramatic change in retail, in education, in health, in so many different areas of our economy and our society. We've seen that with our own portfolio companies. A good example is Fiverr, which is an Israeli freelancer marketplace listed on New York Stock Exchange last year, that has seen its share price triple since the start of this year, off the back of both very, very strong structural growth that was occurring last year and over the last several years, about 40% year on year, but really seen its growth supercharged as a result of this pandemic. And so we're seeing this kind of real move to online, which I guess is the thesis that us and others invest behind. That's essentially why we exist. But then combined with that, we expect to see this incredible burst of innovation over the next few years. And there's a combination of reasons for that. One is there's just going to be a lot of problems that need solving. And so using education as an example, most traditional education institutions resisted distance learning for the last 20 years. They really didn't want to know about it. They did as little about it as they could. And suddenly in the space of a week, they had to transition their entire business, their entire delivery method to online. And so again, 20 years of doing very little and then a week having to do everything. We all know that the future of schools and universities isn't kids sitting at home and doing their classes from home. But equally, the future isn't what it was prior to this pandemic. And so that being just one example of a massive sector of our economy that's going to need really to be reimagined and combine the best of the way in which we've done things traditionally and the learnings that we've had through this period. And so sector after sector is going to need reimagining. And then that's colliding with lots of people sitting at home, having time to stop and reflect and think. I suspect every single person on this webinar has spent a lot of time the last 10 weeks thinking about a whole range of things in relation to their personal life, their investing, their business, what's important in their life. And so people have got a lot of time to stop and think and reflect. And that's going to lead to a lot of, a real burst of innovation, real creativity, combined with the fact there is going to be a lot of talented people looking for jobs or not happy in their current jobs or in organizations that are really, really struggling. And so I guess, and maybe it's a good time, Will, to sort of bring this to a close and move to sort of Q&A. But that's sort of, I guess, the guts of why we think from a perspective of innovation and early stage investing, why the next 3 or 4 years is certainly going to be, I think, the most exciting period since the late 90s.
Just before we do move on to Q&A, we have quite a number of people on the call that are either they're holders of either funds 1 or 2. Could you just touch on the performance? We don't often get the opportunity to hear from you, and just to touch on the fact, whilst I don't like to sort of plug new things, but you are looking at a new fund.
Yeah, no, we are fundraising at the moment, and sort of well advanced. That I mean, we've got 3 vehicles. I think most investors, as you say, Will, are in Fund 1 or Fund 2. We may have 1 or 2 on the call who are in Fund 0, which is a series of sort of special purpose vehicles with investments sort of through 2012, 2015. And I will get, I'm going to embarrass, I'll get the numbers slightly wrong. And my colleague Leela's on the call and she's going to be tearing her hair out that I'll get it slightly wrong. But Fund 1 is Fund 0 is in low 20%. So I think it's 21, 22% IRR. Fund 1 is in high teens percent. I think it's about 18%. And Fund 2 is a very high IRR because we've had a sort of a couple of big markups and an early exit, but it is a young fund, and I think it's a 44% IRR were the numbers. I think I'm pretty close to the mark. I might have got a tiny bit wrong. We'll do a revaluation at 30 June, and there are some assets that no doubt will form a view might be impaired in one form or another, but we actually expect the net asset value at 30 June to be higher, and in some cases significantly higher than at 31 December. I mean, I mentioned Fiverr as an example of which is by far our largest holding. That current holding's worth, I think, over 200 million Australian dollars in terms of the current value of that holding. And so we'll probably actually see 30 June a higher net asset value than at 31 December. Some will be written down, but more will be written up as a result of subsequent capital raising rounds, or in the case of listed companies like Fiverr, based on their share price.
Okay, great. Look, just start the questions off. You're talking about timing being right. I can remember being in Madrid 2 years ago when you were allowed to travel, and there was a guy who was a venture capitalist who was talking about, it's not just a good idea, but how crucial the timing is. And he said, 20 years ago, he started up a website to sell jeans online, and he said it failed.
Yeah.
And just how crucial, if you could just point at that, regardless of how good the idea is, how important that timing is.
Yeah, absolutely. So let's talk about the jeans online. It's a really good example. Why is it easier to sell jeans online today than 20 years ago? And it's both, I guess, push and pull factors. Like, firstly, a lot more people are online. A lot more people are used to buying online. A lot more comfortable with buying online. But there are a series of problems. Leave aside kind of consumer behavior, a number of people on the internet. There are a number of problems in 2000 that made it really, really hard to sell jeans online. First, it was really hard and expensive and difficult to build a website. Now you go to folks like Shopify, which is an incredibly successful company with about a $30 billion market cap, maybe more now actually, that basically they give you a website. Payments used to be hard to establish a merchant account with the bank, hard to assure customers in terms of security and risk. Now you just literally, it's a line of code and you've integrated Stripe. Amazing company that we've got an investment in, now valued at about $40 billion, that was started by 2 young Irish brothers who were 21 and 19 at the time, about 9 years ago. Extraordinary company. There was a piece around sizing, and there's been a bunch of stuff around design and user interface to get better idea around sizing. That obviously is still a bit of an unconquered frontier. What happens if it doesn't fit? And again, the whole reverse logistics piece and getting things back the other way, a lot of those problems have become easier and simpler. Logistics piece have become easier. I mean, if you're an Amazon Prime customer, it doesn't cost you anything for delivery. You pay your $100 a year, you get your free Amazon Prime Video for a year, and you get free delivery for most things for a year. So each of these problems that were barriers to e-commerce have been, not all of them, there are still some remaining challenges and issues, but a lot of these problems have been solved. And that's exactly what we see in technology. And this is the trap that incumbent businesses fall into all the time, because I suspect a jeans retailer back in 2000 have said, we don't have to worry about the internet. You know, no one trusts the internet. Not many people are online. How do you know your credit card information won't be hacked, et cetera, et cetera, et cetera. But it assumes that technology is static when it's actually incredibly dynamic. And smart people, smart founders go out and solve these problems one by one.
Good. Could you also touch on the fact that you guys are about to open a Singapore office or have opened a Singapore office? You've made investments in Southeast Asia for quite a number of years now, and there are quite a few in the portfolio. So could you just talk about the opportunities? You know, Asia's seen by everybody as this great opportunity, but you know, you've been there, but you've also where you've been based and concentrating on is Singapore.
Yeah, I mean, Singapore is for us is a hub for Southeast Asia. And so when we think about Singapore, we think about Singapore, Malaysia, Thailand, Vietnam, Indonesia, Philippines, etc., all the markets of Southeast Asia. And I'll go back. I mean, I think for us, the story of Southeast Asia and technology adoption and creation of value with online businesses, you know, really good metaphors or analogies are China and India. At Seek, we first invested in China in 2006. We bought 25% initially of a company called Zhaopin, which we always used to tell people was one of the top three online employment sites in China. You know, if someone tells you something's the top three, it means it's number three. You never hear Coca-Cola saying we're one of the top three cola beverages in the world. And so it was a number three player. It's now the number one player in China. But we bought a stake in that business, and Andrew and I started spending a bunch of time in China, and I served on the board of that company until I left Seek in 2011. And you know, the internet scene in China was incredibly small. It was very nascent. There were a handful of companies, a relatively small market cap, very low revenues. It wasn't a very exciting scene. Compare that today with Alibaba and Tencent and Baidu and ByteDance and many of the greatest companies in the world are Chinese technology companies. Look at India. Look at India going back probably 7 or 8 or 9 years. Again, we started to see that market really, really take off for technology companies. We've seen the same phenomena in Southeast Asia over the last 2, 3, 4 years. And so we've been investing there. We made an investment in WeGo, which is an online travel business, in 2012. We made an investment in Property Guru, which is the realestate.com.au equivalent in 2015. So we made investments there for a number of years. But my colleague Tushar, when he joined 4.5 years ago, really, really focused on Southeast Asia. He's made a number of investments in there. Most recently, a telehealth business called Doctor Anywhere. We closed that deal about 6 or 8 weeks ago. And incredibly excited about that market. And that market, we think, looks like China did 10 or 12 years ago, looks like India did 7 or 8 years ago. Very, very high GDP growth, large population, very young demographic. Everything operates online, primarily through the mobile internet. Incredibly exciting dynamics and frankly, not an overly competitive VC environment, particularly at sort of Series A and Series B where we invest. So Tushar has done an incredible job in that market, essentially flying in, flying out, and frankly, probably at a degree of personal cost. It's incredibly exhausting for him. He's been doing a trip every 3 weeks or so for the last few years. And so collaboratively, we made the decision to put a presence on the ground in Singapore. We've hired a guy out of BCG, Ed Barker, to join Tush. They were moving over last month. They'll move over as soon as they can fly. And really, really excited. We'll build a team over there over the next few years, a larger team over the next few years. and incredibly excited about that market. And obviously Southeast Asia alongside Australia and Israel are the three core geographies that we invest in.
Damon's asked a question. Where are you seeing the pain points in the current VC landscape? Are there any new rounds getting away, or have high net worth stopped backing them? Do you expect super funds, for instance, Post Plus, to become more wary of devoting capital to this space?
Yeah, look, there's a few questions in there, and Damon and I probably will no doubt chat afterwards. You know, I think the first reaction was, you know, and I, you know, my career started as a young lawyer in March 1991. You know, depending on your perspective, either a very good time or very bad time to start your career. But the last recession we had until this one, and then obviously lived through the dot-com crash and Seek, and then GFC. You know, every crisis, I was going to say every pandemic, every crisis is different, and this crisis is very different. I mean, the dot-com crash was all about why this internet thing was overhyped, crazy. You know, complete and utter group of cowboys and lunatics. You know, we went from when we started in late '97, we were like, what's this internet thing? Who are you guys? What are you doing? You know, by '99, we're complete geniuses. And then early 2001, we were idiots again. And so, you know, that was what that particular crash in the technology sector was about, which was the complete perception of overhyping a technology. Now, of course, if people had gone out and invested in Amazon at a valuation of $2 or $3 billion in 2001, 2002, when it's now over $1 trillion market cap, you'd be very happy. But it is what it is. This crisis, I mean, the things I said about this crisis and the impact on accelerating the take-up of technology, I'm obviously not. It's not a particularly insightful view. You know, lots and lots of people have that view, and so as a result, I mean, normally in a crisis like this, you would see less money going to illiquid investments. There will certainly be some people who say, look, my portfolio is in a bit of a mess, I'm feeling nervous. But because I think people can see, you know, the points that I made, I think are fairly clear around what the next era looks like. You know, frankly, anyone who's been investing in early stage through and the last few years have been a good period for early stage, have been delivered very good returns. And we chat about the IRRs semi-accurately before. Anyone who's invested in VC in the last few years has had good returns. But anyone who says, I've been in VC the last few years and steps out now is probably pretty crazy, because, you know, vintages do matter, and this will almost certainly be you know, unless something goes really, really wrong, this will be a great vintage. And so, you know, we've you know, both angel investors in terms of investing in early stage companies, family offices and institutions investing in funds like ours and other funds. You know, certainly is, you know, we'll have more to update people on in the next few weeks and months. But certainly to date, it's been really, really good, and we're really pleased, particularly given that people are feeling, you know, stress in their portfolio right now.
Thank you. Look, Michael has asked, thinking of the current raising investors so that they can progressively invest and spread the funds rather than having to make one-off relatively large bites. Yeah.
Look, we do, you know, I think the minimum for the fund is $250,000 US. So it's not a trivial amount. We do, just to answer that specific question, people commit that amount to invest in the fund, but that is going to be drawn down over, you know, as you know, Will, is going to be drawn down over several years. So people don't have to put up that money on day one. You know, typically that'll be drawn down, you know, probably 50 or 60% of it will be drawn down over the first, on average, 2.5 years. And then the rest will be drawn down over the next 3 or 4 or 5 years. We return money progressively as we have exits. We sold in Fund 1 part of our position in Fiverr and returning that capital. So as we exit positions, we do you know, we do return capital. So from beginning to end, they are long dated investments. But actually, the period of your peak capital being in there is shorter. And look, it's a hard one. This is an asset class that really suits some people. It obviously doesn't suit everyone. As an investor, you know, my perspective is if I can get good returns, if hopefully a manager can deliver good returns for you, which is obviously never guaranteed, it's always the aspiration, you would far prefer be compounding a given return over a longer period of time than a shorter period of time. I think that's a sort of an obvious comment. And so For some investors, they love the time periods, they love the illiquidity because it effectively allows them to create value over a long period of time. For others, they say it's not for them, and that is completely understandable.
Another Michael's asking, do you have a view regarding VC opportunities for medical device technologies in the current environment?
Yeah, we don't do stuff that is what I'd call life sciences, but healthcare is so where it's sort of requiring FDA approval and the like, or TGA approval is outside the area we invest in, but we do a lot in healthcare. So we've invested, for example, in Health Match, which is essentially a marketplace connecting patients with clinical trials. Investment we made last year, obviously a very, very topical investment. We've invested in ADOC, which is an Israeli company, AI for radiology. I mentioned Dr. Anywhere in Southeast Asia, which is a telehealth business. So we love healthcare as a vertical. We think, it's about 10, 11% of the economy in most Western countries, most developed countries. It's about 17 or 18% of the economy in the US, which is nuts and crazy. Something's got to give. We need to have a whole lot of solutions. I think it's going to be a really, really exciting era for health tech, but also, and again, this next comment is probably said without a lot of expertise, but in relation to medical devices, drug discovery, etc. Part of the reason why drug discovery is going to get a lot more exciting is, and we're actually looking at a business at the moment that falls right into this area, is there's a lot of AI. There's a lot of AI being applied to drug discovery. And so the ability, because, you've got these millions and millions of compounds and what works and what doesn't work, the ability to actually use AI techniques to actually model whether compounds will work or not work. Secondly, time to market has obviously been a massive issue, whether it's for pharmaceuticals or whether it's been for medical devices. Clearly, one of the things that are going to come out of COVID-19 is, assuming there is a vaccine, it is going to come to market in absolutely record time. And everyone's going to stop and think and say, why have we, again, this is the sort of innovation that comes out of crises, is why does it have to take 10 or 12 or 15 years and several $1 billion to take a drug to market? That makes absolutely no sense. And we've just accepted it for decades. And now we're saying, you know what, actually we can do things differently.
Yep. Eric is asking, have any of your existing investments proven to be particularly appropriate to the current crisis, or have been able to easily adapt their IT to become appropriate, i.e., or e.g., Zoom-like products?
Yeah. Well, Zoom would be really good. It's an amazing company, and I wish we were investors in Zoom. And just an aside on Zoom, I'm a big Zoom spruiker. Any product that can go from 8 million daily users to 300 million daily users without a hiccup. At Seek, when the traffic, in our early days, when the traffic increased by 1%, the servers would start crashing and frying, and we'd be like, what do we do here? We didn't expect all this traffic. It is a feat, is an engineering feat that I think is taken for granted. It is extraordinary. Look, we've had, our portfolio, the way we think about the portfolio through the crisis is cash, short-term, long-term. Cash in a way is the most important, because clearly if you're a business that is negatively impacted by the crisis and you're short of cash, that puts you in a difficult position. We've been very, very lucky that very few of our portfolio companies went into the crisis short of cash. I guess our mindset, our founders' mindset has been pretty cautious over the last 12, 18 months. Obviously, zero visibility of a pandemic, but it felt like we were getting nearer the end of a cycle. And so particularly our largest portfolio companies have raised a lot of money in the last sort of 12, 18 months in very, very strong financial shape. Then around the long term, most of them are beneficiaries because of this trend towards things moving online. And then there's the short term. The short term is a real mix. Companies like Health Match, I mentioned earlier, one of the things they've done, they haven't pivoted the model, but anyone doing COVID trials, and there are several hundred going on right now, they can put those trials and recruit patients free of charge. As an example, I mentioned Fiverr, where Fiverr is a incredible resource for businesses that suddenly, say a retail business, for example, that suddenly needs to go online and needs a whole lot of stuff related to going online. Search engine optimization to acquire customers, design services, software engineering services. Fiverr has really, benefited from that trend. Other companies like Deputy, for example, a lot of their customers are in hospitality, and they're obviously really, really struggling. So they're allowing their clients to sort of hibernate their accounts, so they can sort of come back on, sort of immediately without sort of having to restart a sort of a client relationship. ADOC, another company, AI for Radiology that I mentioned earlier, has created a product which can detect COVID in scans, in CT scans. And so, you see, like we've seen across the board, whether it's yoga teachers, whether it's chefs, whether it's all sorts of different organisations, we've all been forced to be a lot more creative, and we're really, really proud of what our founders have done to kind of both look after their staff, look after their customers, provide products and services that are a benefit to the community in a difficult time.
Andrew's asking, where do you exit most of your investments, and how does this landscape look in the next 5 years?
Yeah, it varies. I mean, generally in technology, you see more M&A exits than you do IPOs. We've had I'm just trying to remember now, 4 or 5 M&A exits to date. We've had 2 companies, 3 companies, I should say, IPO. So we've had 4 or 5 M&A exits. We've had 3 IPOs. In Australia, exits tend to be a little bit more via IPO than other markets. Traditionally in the US, trade sales are probably, 5 to 1, 10 to 1 compared to the number of IPOs. Same in Israel, maybe even more so. Australia, we've had a lot of our best technology companies have gone down the IPO path. Atlassian as obviously a really good example. It's now, I think, a $45 billion market cap. Realestate.com.au, car sales, whole range of different businesses that have listed both here and offshore. But it's trade sale, it's IPO, it's private equity buyers, and also secondary buyers. There are a whole lot of funds that exist to buy positions from venture capital funds and the like that might be getting near the life of the fund. So there's a number of different exit options for VCs like ourselves.
Michael's asking another question, and I'm just going to add something to it, Michael. Israel's a key focus for Square Peg. Do you put any weight in geopolitical risks when investing in Israel? What I'd like to add is a few years ago, I went to a presentation at Deloitte with a group from Israel called iAngels. And I went to learn about Israel. And I think it's important to put it in context, why Israel, and why Israel is also the innovation that comes out of Israel, and why does that seem to be at such a level that is greater than a lot of other places? Yeah,
look, it's a great question, and it's a really important question. And it's funny, we were actually chatting about this in a different context, a few of us in the team yesterday. One of the things we like about Israel is, and there are many, so this is probably one of the smaller factors, is some people are put off by the market because it's perceived as a difficult, hard place because of the geopolitical issues, and you probably don't therefore get as much. You do get a lot of competitive intensity with VCs and strategic investors and the like, but perhaps not as much as you might otherwise, but for the fact that because of these geopolitical issues, etc. And, I'm reminded of, Korea. Macquarie had massive success in South Korea going back 15, 20 years when they were able to acquire infrastructure assets way cheaper than in other parts of the world because people were concerned about geopolitical risk and proximity to North Korea and all that sort of stuff. And obviously South Korea ended up being an incredibly happy hunting ground for Macquarie. But that's a little bit of context. I think, your question, Wills, is a really important one. Israel, for those that aren't familiar with it, and we've taken a number of our investors there. We took a group of 45 of our investors going back 4 or 5 years, and a lot of them had never been to Israel before, and they were just blown away. Firstly, like just how safe and comfortable they felt there, but just the dynamism, the innovation. You've got a country of 8 or 9 million people, not literally an island, but effectively an island, doesn't trade with its neighbours, is in a sort of state of war or cold peace with all of its neighbours. You have everyone going through, or most of the population going through compulsory military service, incredibly creative, incredibly innovative. I remember talking to one of our portfolio founders. He was a software engineer, and asking him about the product he's building. So this seems really complicated. How hard is it built? He said, you know what, when I was 19 and 20, my job in the army was basically writing the software for the rockets that take, anti-rocket rockets that take the rockets attacking us out of the sky. And he said that this is pretty easy after what I did when I was 18 and 19. So these people get incredible opportunities, incredible experience, develop these very, very strong networks. There's a self-perpetuating nature to innovation. There are really only, 2 places in the world where most of the best and brightest gravitate towards technology startups, and that's the Bay Area and Israel. And so, if you look at our portfolio founders, we've got about 5 or 6 pilots in there. We've got 3 or 4 from the most elite combat unit in Israel, equivalent to Navy SEALs type unit or SAS. We've got 5 or 6 from the most elite intelligence units in Israel. And so the very, very most talented people gravitate towards startups. And so this combination of getting incredible opportunities and experience, the opportunity for young people to work in startups and so get lots of learnings and experience there as well as their army service, lots of capital, lots of corporates that want to partner or acquire these businesses. It is an incredibly vibrant ecosystem, and one that we in Australia we can learn a lot from. Now, clearly, there's lots of things that don't apply. I mean, we are an island, but we've got New Zealand as our neighbour, and they're not going to send missiles over, not this week anyway. And so, but there are certainly some really good learnings.
Damon's asked another question. Given your investments in America, how concerned are you about the global geopolitical environment and the ongoing growing tensions between the United States and China, and Australia's position in the middle of that, being hit with trade sanctions?
Yeah, I mean, with Australia, Australia has always been our major trading partner. Throughout our history, our major trading partner and our major security alliance partner has been the same country. Essentially, in simple terms, the UK up to the Second World War, and then the US since the Second World War. And going back, 10, 12, 15 years, those 2 things diverged. From a security perspective and a values perspective, our alliances with the United States. From a trade perspective, our trade perspectives with China. I mean, just as an aside, I remember coming back from overseas. It's probably about 2 or 3 years ago. I was early one morning, and as I was walking back from the terminal to my car, and there were some Chinese tourists going the other way with literally piles and piles of suitcases on their trolley, and they were sort of falling off the trolley. And there was a guy standing next to me walking the same way who sort of started laughing a bit. And then there was an American guy said to him and said, "Stop laughing, mate. You guys be fucked without the Chinese." And it's sort of hard to argue that point. And having done business in China, I've got great empathy for what the Chinese have done and achieved over the last 30 or 40 years. It's unprecedented in human history, at least the scale and the pace at which they've occurred. I mean, more people have come out of poverty in the last 30 or 40 years than any other time in human history, and most of those people have been in China. And so, there is a lot of things that we can be very critical of China about. There's a lot of things we can say, wow, this is amazing. Both of those narratives are very fair. Frankly, same about the US. Look, the US, it is very easy to look at the US and say, this is a nation that kind of looks like it's becoming a failed state over the next decades. And equally, there's a lot of things about the US you can say, this is the most extraordinary country in the world. Again, the situation is very, very polarized. But there are so many signs that the US is, a country in very, very deep, very, very deep issues. I mean, just one example is obesity. And again, it's not an issue unique to the US, but the level of obesity in the US says something about the culture, frankly. The level of gun violence in the US says something about the culture. The political divide, this willingness to believe in conspiracy theories, a president who espouses conspiracy theories. I mean, it's the great tragedy of our lifetime, what's happening in the US. Now, the US has gone through other difficult periods. They will hopefully work this out. They may not. I don't think it's a guarantee that we'll have election in November. I think it's a possibility that the US will become a dictatorship by the end of this year. I think it's a very low probability, but I think it's definitely a low possibility. But I think it's definitely a possibility that the US will effectively be a dictatorship by the end of this year. It is unprecedented, even to be thinking that. And maybe it's a 1% chance, maybe it's a 5% chance. But we can all see scenarios where there is no presidential election or congressional elections in November. And so it's just a really, really complicated time, but we can't lose sight of the fact it is the home of most of the great innovation in the world. Most popular culture in the world comes from the US. That it is just this extraordinary contrast for a country, and even the way it's dealing with COVID right now. It's a mess, and it'll work through it, and it'll get through it, and it'll get there. But it just does things differently to the rest of the world. And how this pans out. And so really long-winded answer. Coming back to Australia, we have tried very hard to kind of keep friendly with the US and keep friendly with China. And most of the last 15 or 20 years, that hasn't been that hard to do. The last 5 years, it's become very, very hard to do. And we're sort of working out how to do it. And, there's no easy answer. I don't think we need to be or should be hairy-chested with either relationship. They're both critical relationships for Australia. But I think it is so complicated. But I do think, I talked about the rise of the internet. The other great story of our lifetime is the rise of China. They are the two big defining themes of the last 30 years.
Good. Look, that's it on the questions. So, Paul, look, thank you very much for your time and insights. That was absolutely fantastic. We very much appreciate it. For everybody listening, there will be a recording that will be available at some stage tomorrow. Also, early next week, we'll be sending out our next invitation. But, Paul, once again, thank you. And thank you, everybody, again for attending, and have a great evening.
Thanks, Will. Great to chat.
Okay, bye-bye.
Bye-bye.